There is a new $6,000 tax deduction available if you are 65 or getting close to it, and whether you actually get it depends on 4 things: your birthday, your social security number, your filing status, and your income. Get any one of those wrong, and the number on your return is not $6,000. It might be smaller, or it might be 0. Here is exactly how the Internal Revenue Service defines who qualifies, using the actual tax form the agency published for 2025. This is officially called the Enhanced Deduction for Seniors. It was created by the tax law passed in the summer of 2025, and it is temporary, available only for tax years 2025 through 2028, unless Congress extends it. It is separate from your regular standard deduction and separate from the older additional standard deduction that has existed for years for people 65 and up. Think of it as a third brand new layer stacked on top of both of those. You may have also heard this described as no tax on Social Security. That is not quite right, and the difference matters. This deduction does not touch the underlying rule for how Social Security benefits get taxed. Up to 85% of your benefits can still be taxable exactly as before. What this deduction actually does is lower your overall taxable income, which for many retirees has a similar practical effect, but it is a general deduction, not an exclusion carved out specifically for Social Security income. Start with the first factor, your birthday. You have to have been born before January 2nd, 1961, which in practice means you turn 65 on or before December 31st, 2025, not sometime in 2026. The second factor is your Social Security number. It has to be valid for employment and issued by the Social Security Administration before the due date of your return, including extensions. An individual taxpayer identification number does not count. Once you clear those requirements, the maximum amount is $6,000, and that number belongs to a person, not a household. If you are married, filing jointly, and both you and your spouse individually meet the age and Social Security number rules, you each bring your own $6,000 entitlement to the return for $12,000 combined. If only one of you qualifies, there is only one $6,000 entitlement to bring, so the household tops out at $6,000, not $12,000. That brings us to the third factor, filing status. And here is the rule that catches people off guard. If you are married, you must file a joint return to claim this deduction at all. File separately for any reason: a spouse's medical debt you do not want to be liable for, a pending divorce, simply preferring to keep finances apart. And this deduction disappears entirely, even if you personally meet every other requirement. One quick side note before the fourth factor. This deduction does not care whether you itemize. You can take the standard deduction and still claim it, or you can itemize on Schedule A and still claim it, and neither choice locks you out of it. It sits on its own line, on a new form called Schedule 1A, and flows into your total deductions either way. Now the fourth factor, and the one that actually determines whether you get the full amount, income. The deduction starts shrinking once your modified adjusted gross income, or MAGI, passes $75,000 if you are single or head of household, or $150,000 if you are married filing jointly. For every dollar of income above that line, the deduction is reduced by 6 cents. Here is what that looks like in practice. Say you are single, 67, with a modified adjusted gross income of $100,000. That is $25,000 over the $75,000 threshold. Multiply 25,000 by 6% and you get $1,500. Subtract that from 6,000 and your deduction is $4,500, not the full 6,000. Now picture a married couple, both 65, filing jointly with a combined modified adjusted gross income of $180,000. That is $30,000 over their $150,000 threshold. 6% of $30,000 is $1,800, and that reduction applies to each spouse's $6,000 share. So each spouse's piece drops to $4,200 for a combined deduction of $8,400. The reduction keeps climbing until it wipes the deduction out completely. For a single filer, that happens at $175,000 of modified adjusted gross income. For a married couple filing jointly, it happens at $250,000. Above those levels, the enhanced deduction for seniors is zero, regardless of age. If your income keeps you under the threshold, this new deduction does not replace anything you already get. It's tax on top of it. Start with your regular standard deduction. For 2025, that is $15,750 if you are single, or $31,500 if you are married filing jointly. On top of that sits the older additional standard deduction for being 65 or older. $2,000 if you are single or head of household, or $1,600 per qualifying spouse if you are married filing jointly. Add the new $6,000 senior deduction on top of both layers, and a single filer under the income limit ends up with $23,750 in total deductions before taxable income even enters the picture. Whether any of this meaningfully changes your tax bill depends entirely on your income, your filing status, and how close you sit to that phase-out range. If your modified adjusted gross income sits comfortably below $75,000 or $150,000 filing jointly, this is close to free money on your return. If you are married and currently filing separately for reasons unrelated to taxes, it would be worth running the numbers both ways, since this deduction alone could tip the math toward filing jointly. And if your income sits well above the phase-out ceiling, this deduction simply will not apply to you, no matter your age. This is not tax advice for your specific return. A qualified tax preparer can run your exact numbers using Schedule 1A. But now you know the actual test the Internal Revenue Service applies: your birthday, your social security number, your filing status, and finally your income in that order. Thank you for watching all the way to the end. If this video gave you something to think about, do one small thing: subscribe to Retirement Decisions Desk. Every video here unpacks one retirement decision, and subscribing is how you'll never miss the next one. Take care of yourself, and I will see you in the next video.